Hi guys, welcome back. Today we'll be looking at the company Verizon and how this company will be going into the future, especially with it being a telecom community and then the release of 5G, especially in the US market, and where this company will kind of sit within the new trend that will be coming here. So the stock price is $58.84 as of me making this. As always, if you do enjoy, please consider subscribing and onto the video. So let's go. So the future expectations of the Verizon company. So Verizon has gone all in on this 5G trend. It hasn't really tried to diversify its portfolio here. It's kind of just invested a lot into growing its 5G potential to kind of give it like this boost of growth potential. You might have, as I'll touch on this later, you might see me coming back to the fact that this company doesn't really have any future growth potential, but this 5G helps this company overcome that problem. And this company being one of the largest telecom companies in the US and having one of the deepest pockets and the largest free cash flows, it can invest a larger amount of money into 5G without taking an as great a risk as other competitors such as T-Mobile. It has invested tens of billions of dollars into 5G, and it's kind of extended its reach now so that 5G covers 230 million people and 2,700 cities. But this has only realized into 24 million new customers in 5G. On the left here, we have some data that they've given based on their website about the future of 5G. If you want, you can pause the video and go through that. Otherwise, it kind of goes into more detail about the technical analysis, not technical analysis, kind of like the technical procedures about how their 5G works and where they expect it to go in the future. Anyway, so the financials of this company. The return on equity on this company has been consistently increasing from about 6.36% back in 2012. Once again, I will try to fix this. I don't know why my face keeps covering this. But currently, the return on equity is 33%. So you can see that it has a very good return on equity and is using its cash to a very good standard, almost double what we wanted of 15%. Its earnings per share has been consistently increasing to 2017, where it's gone from 0.9 dollars in 2010 to $7.36 in 2017. However, what has happened that in 2018, 2019, and 2020, it's been dropped since at $7.36. So in 2018, it was $3.76. In 2019, it was $4.65, and in 2020, it was $4.42. So it kind of had like an uptrend, and it had a falter, and it kind of kept going back up there. More to do with acquisitions and stuff they did, kind of spending a lot of money during that time, which has led to reduction in earnings per share. But you could see backing into its return on equity during that time was 32% and 33%. I do not believe it is that big of a worry. That shows that they're still being, although they made slightly less money because they spent more, their return on equity was still quite good. You could see that free cash flow was increasing consistently since 2010. It kind of went up, and then once again at 2017, 2018, 2019 section, you could see it went down from $21,000 to $11,000, $5,000, $7,000. So you could see that they were spending more money there, which resulted in a lower earnings per share. So I don't believe it was necessarily through some mistake in how they conducted their business or a loss of customers. It was more to do with the fact that they were spending more. Their interest coverage, you could see it kind of started at 6 and now it's 5.81, so it kind of hasn't really moved anywhere, showing that they don't have the greatest interest coverage because I'll touch on to later how their debt's pretty high. However, the interest coverage is acceptable as it's greater than 4 years. So over the next 6 years, they can still pay interest of their debt, which is not too good, but it's not terrible either. Its debt to equity ratio, you could see towards the middle, it was close to 9. However, since then, it's been a steady decline down to 1.94. While 1.94 is still much excess of what we really want it to be, it still shows the fact that they are slowly paying off their debts, which is not necessarily a good or bad thing. But the fact that they are paying it off is good. But the bad part is that there's still a lot of debt to be paid off. Their net margin has consistently increased from 2, where they were spending a lot of money back in like 2010, and then uh, it kind of increased into 13, 10, 23, 10, 14. So you could see once again 2019, 2018, 2019, both of those, their net margin was significantly lower, once again linking back to the fact that they were spending much more. However, this net margin doesn't seem to dictate any sort of trend because it's kind of all over the place. But I would say it's still not a terrible net margin, because I'd assume at this standard they would still have a 10% net margin, which isn't, once again, it isn't great, but it isn't terrible financially. They pay a very stable dividend yield of 4.6%, which puts them into the top 25% dividend payers in the US. And they've also been consistently increasing their dividends over the last 10 years as well. So they pay a very good dividend. And you can see their PE ratio is 13, which is very good compared to the market of 31.5. Basically showing that in terms of value, this company is quite undervalued based on what the market is valued as a whole in terms of in relation to its earnings. Some pros and cons about this company, according to Simply Wall Street and their analysts, it's trading at 45.8% below their estimate of a fair value. And the earnings are forecasted to grow 5.91% a year, and the earnings, which once again 5.91% isn't extremely high, but this is a more of that dividend blue chip stock rather than like a growth stock that's growing 30-40% every year. The earnings have grown 5.6% per year over the last 5 years, once again showing a good stable build up in their earnings and revenue, so that's good, and pays a high and reliable dividend of 4.2%. However, once again, as I already mentioned, the risk was the high level of debt, and they've also had significant insider selling over the last 3 months, highlighting that the people in the company do not necessarily have the faith that they used to when they were buying the shares. So just some comparisons to the market and their competitors. So their PE of 13.3 is much better than the US market of 30.5 and is better than the industry of 10.5. Its PEG ratio is 2.3, which is actually quite high, indicating that the growth is very slow. However, this is expected as it is not a growth stock, which is why it pays dividend and has a low PE ratio as well. Its future ROE of 28.5% shows it is currently has a very good use of money, and it will continue to do so in the future as well. Its price to book ratio of 3.7 is showing that they don't necessarily have too many tangible assets compared to the price. So it's not exactly an asset play stock, similar to like what a bank or a REIT would be. Its revenue and profit growth is set to be solid yet slow, kind of growing in line with the industry, but slower than the market as a whole, because the market is kind of getting more and more tech heavy, with the tech stocks kind of keep pushing the top line higher. But this growth that with solid yet slow might be solid yet fast if they do kind of pop off with the 5G growth that they've kind of banking on. Its dividend yield of 4.27% puts them into the top 25 payers of the dividend payers in the US market. And they've also consistently been increasing their dividends over the last 10 years as well. But their very high debt suggests that this company is still very vulnerable when it comes to terms such as if they lost customers or their market share was taken over if the 5G thing kind of fails. So it's kind of a gamble with the 5G. And this very high debt kind of puts another risk on top of the company there. The company as a whole has strong past earnings, has a decent balance sheet, except the high debt, but it kind of lacks the growth factor that would drive it forward, pushing it into like from a solid, decent company to a very good company in the future. And that's kind of why the company has bet on 5G. So just looking at the technical analysis over the last 5 years, you could see that this company has consistently been going on an uptrend. The highs are getting higher, the lows are getting higher. And you could see the yellow line being the 500, the 200 SMA, the blue line being the 50 SMA, 20 SMA, and the aqua line being the 50-day simple moving average. And you can see that recently this stock price kind of tanked from its $62 high to kind of like $59. And that has kind of pushed it down from being much higher than the 20-day simple moving average, down to the close to the 50-day moving average, kind of coming into the buy zone again, not completely, but kind of entering that. If you go down to the 1 year analysis, you could see this a lot better, where the stock price was originally close to $62, but now at 59, it's close to the 200-day simple moving average. This basically indicates that this stock hasn't moved too much across this year, especially with some stocks halving in price, other stocks doubling or tripling or quadrupling in price. You could see that this stock is generally quite stable, indicating like a lower interest, a lower volatility. And because of that, it could be considered a safer bet with a good dividend yield for the long term. So just some final remarks about this stock. The stock as a company seems pretty solid, but I do believe that the best of this company, where the company was really leading the market, is behind, like in the past. So I don't believe that this 5G will really be pushing this company even higher, because the 5G market will be very competitive, and the growth potential of this company does seem quite overhyped when it looks to a lot of other what other people have been talking about this stock. However, if you do believe that this potential of this 5G does kind of like shoot up, increasing the stock price, because maybe you know something that I haven't covered, or you just understand this industry slightly more, there is potential, and if you do believe there's potential for it to actually happen, you could invest. However, personally, I wouldn't recommend it, or I wouldn't buy it myself. But as always, do your own due diligence, and I'll see you in the next one. Thanks for watching. Bye.